Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host, AlgoBot, and today we're studying an expert advisor called Nested Trend Pullback. This is a trend continuation strategy with a clever twist. It reads two scales of the market at once, but from a single chart time frame. Over the next few minutes, you'll learn how it builds a slower trend view, how it times entries on short pullbacks using a pair of moving averages, and how it manages risk with the average true range. Let's dive in, for educational purposes only. So what exactly does the Nested Trend Pullback Expert Advisor do? At its heart, this is a trend continuation approach. It tries to join an existing move after a brief pause, rather than trying to predict a top or a bottom. What makes it unusual is that it looks at the market on two scales at the same time, yet it only ever reads a single chart time frame. The first scale is what the strategy calls the tide, the bigger, slower direction of the market. Instead of loading a separate higher time frame, the EA takes the closing prices from your chart and samples them thinly, keeping only one close every few bars. This downsampled series behaves like a slower time frame built from the same data. A fast and a slow exponential moving average are then measured on that coarse series to decide whether the tide is flowing up or down. The second scale is the ripple, the short-term entry timing on the actual bars of your chart. Here the strategy waits patiently for a one-bar pullback that pushes briefly against the tide, and then it looks for the very next bar to resume in the tide's direction. That pause-then-go behavior is a classic continuation pattern. Risk is handled with the average true range, a common measure of recent volatility. The stop distance and the profit target both scale with that volatility, so the strategy adapts to calm and busy markets alike. This approach can be applied to many instruments and timeframes, currency pairs, indices, metals, because the coarse view rebuilds itself from whatever chart you attach it to. It may appeal to traders who prefer following established momentum and who like clearly defined, rule-based entries and exits. Remember, this is educational information only, not a recommendation to trade. Let's walk through the mechanics step by step. Everything happens once per closed bar, so the strategy is patient and only acts on completed candles rather than reacting to every tick. First, the EA rebuilds its coarse view. It takes the stored closing prices and samples one close every so many bars. The spacing is set by the GroupSize parameter, which defaults to 6. Those sampled closes form a downsampled proxy series that stands in for a higher time frame. On that proxy, the strategy calculates a fast exponential moving average, defaulting to a period of 5, and a slow exponential moving average, defaulting to 12. From those two averages, the tide is defined. The tide is up when the fast average sits above the slow average, and the fast average is also rising compared with one coarse step earlier. The tide is down when the fast average sits below the slow average and is falling. If neither condition holds, the market is judged directionless and the strategy simply waits. Only when a clear tide exists does the EA look at the fine scale for an entry. For a long, it needs the most recently completed bar before the trigger to be a red or down closing bar, that is the pullback against the up tide. Then the trigger bar itself must be green, closing higher than it opened, and it must close above the high of that red pullback bar. When all of that lines up, the strategy signals a buy, because price paused and then resumed upward with the tide. The short side mirrors this exactly. With the tide down, the strategy needs the prior bar to be green, a brief pullback higher, followed by a red trigger bar that closes below the low of that green bar. That combination signals a sell. Risk management is identical on both sides and is driven by the average true range over its default period of 14. The current volatility reading is multiplied by the stop multiple parameter, which defaults to 1.6 to set the stop distance. For a long, the stop is placed that distance below the entry, and the profit target is placed at the stop distance multiplied by the reward ratio, which defaults to 1.8. So the target reaches for roughly 1.8 times the risk taken. The short side places the stop above entry and the target below. The EA holds only one position at a time per magic number, and lets the stop loss and take profit manage the exit. Let's read the actual MetaQuotes language code, just as it appears in the meta editor. At the top are the input parameters you can adjust. GroupSize controls how thinly the closes are sampled for the coarse proxy. HtfFast and HtfSlow are the fast and slow moving average periods on that coarse series. ATR period sets the volatility look back, stop multiple scales the stop distance, and reward ratio sets how far the target sits relative to the risk. Lots is the fixed trade size, and magic tags the strategy's own orders. Next, you can see how the tide is defined. The Boolean tied up is true when the fast average is above the slow average and above its own previous value, while tied down is the mirror image. Below that, the fine scale logic checks the candles. Prior red and prior green classify the pullback bar, while resume up and resume down check that the trigger bar closes past the prior bar's high or low in the right direction. These combine into long signal and short signal. Look at the buy block. When long signal is true, the code reads the current ask price as the entry, sets the stop 1 ATR-based distance below it, and sets the take profit that same distance multiplied by the reward ratio above it. It then calls trade.buy with the lot size, stop, and target. The sell block is the exact mirror. When short signal is true, the code reads the bid as the entry, places the stop the ATR distance above, and the take profit the reward scale distance below, before calling trade.sell. Both sides use the same volatility-based distances, so the risk logic stays symmetrical whichever way the market is leaning. That's the whole engine in a handful of lines. Now let's bring it all together on this illustrative chart. Watch the two lines drawn over the candles. The gold line is the fast-moving average and the blue line is the slow-moving average, both measured on the downsampled coarse proxy. Together, they represent the tide, the slower direction the strategy wants to trade with. On the left, the market is climbing. Notice that the gold fast line is holding above the blue slow line, and it's angling upward. By the strategy's own rules, that means the tide is up, so the EA is only interested in buying pullbacks. It will ignore any short ideas here. As the first few candles print, price pushes higher in a steady staircase. Then we get the setup the strategy is waiting for. One candle closes lower than it opened, a small red bar that leans against the up tide. This is the pullback, the pause in the move. On its own, it means nothing. The strategy needs proof that the trend is resuming. That proof arrives on the very next candle. It opens and then rallies to close green, and crucially, it closes back above the high of that red pullback bar. This is the resumption the EA has been waiting for, and you can see the buy entry marker appear right there. Because the tide was up, the pullback was a single red bar, and the trigger bar reclaimed the pullback's high. All three conditions are satisfied, and the strategy signals along. From that entry, the stop loss is tucked an average true range distance below, near the recent low, and the take profit is projected above at 1.8 times that risk. Watch what happens next. The following green candles carry price up into that target, and the take profit marker is reached. The continuation leg delivered the move the strategy was positioning for, and the trade closes at its target. Now the character of the market changes. Price rolls over and starts to fall. Follow the gold fast line as it rounds off and dips beneath the blue slow line. Once the fast average is below the slow average and pointing down, the tide has officially flipped from up to down. The strategy now flips its bias as well. It will only look for short entries and will ignore any long setups. As price steps lower, we get the mirror image of the first setup. One candle closes higher than it opened, a green bar that leans up against the down tide. That is the pullback, a brief bounce inside the falling market. Again, by itself it proves nothing. The confirmation comes on the next candle, which closes red and pushes below the low of that green pullback bar. You can see the sell entry marker print at that break. The tide was down. The prior bar was a green pullback, and the trigger bar broke the pullback's low, so the strategy signals a short. For this sell, the stop loss sits an average true range distance above the entry, just over the recent high, and the take profit is projected the reward scale distance below. The next candles continue lower and price slides into that downside target, where the take profit marker is reached and the trade is complete. Step back and notice the symmetry. In both cases, the strategy first checked the tide using the two moving averages, waited for a single bar to pause against that tide, and then entered only when the following bar resumed in the tide's direction. The stop and target were always sized by recent volatility rather than by a fixed number of points. That is the essence of the nested trend pullback approach, Align the small entry with the larger flow, and let clearly defined rules handle the rest. Of course, not every signal reaches its target in real markets, and losses are a normal part of any strategy. Let's wrap up what we covered today. The Nested Trend Pullback Expert Advisor builds a slower tide from a single time frame by downsampling closing prices and reading a fast and slow moving average pair. It then waits for a one-bar pullback against that tide and enters only when the next bar resumes in the tide's direction, with stops and targets sized by the average true range. We walked through the logic, read the core code, and followed both a long and a short example on the chart. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like us to study next. You can find more at www.algobot.live. Remember, this is educational content only and not financial advice. Past performance does not guarantee future results. Trade responsibly.